I think if we are going to be getting optimistic about growth, then it stands to reason that monetary policy does a little bit of a review, because my concern is that as we say the same thing about the developed world, and with our own experience in the 2011 to 2013 period, when the stimulus overstayed its welcome, both monetary and fiscal, at least this time around, it is not the question. It's not a question of we are firing from a double-barrel gun, but still, I would say it's important to be vigilant, or signal at least that we are becoming more vigilant on the monetary policy front, because overheating, as we learned in the 2008 crisis, isn't only about inflation. It comes through multiple dimensions, and we need to be aware of that, and we need to be cognizant of that. And in order to sustain the recovery, I think, it is good to sort of signal that the monetary policy makers recognize that the trade-off since the August meeting has shifted already somewhat. That signal would be useful and reassuring from a medium-term perspective.
Can you help us? And you've studied this internationally, and I'll come to the global markets in a bit. But how does this extended period of excess liquidity, how does it start playing into asset price inflation? How do we even define asset price inflation in India? And how do we start factoring that in as a risk?
Well, for example, if you look at the equity markets, and if you look at the cyclically adjusted PE ratios, India's equity market is the second most expensive after the United States, according to many metrics. And then from a structural perspective, we all know that the real estate market, although last year wasn't a big increase in the residential real estate prices in India, so on a structural basis, we are still one of the most unaffordable markets in terms of the ratio of home prices to GDP per capita or incomes, etc. So I think there is always a certain element of excess demand, either due to monetary or due to regulatory policies. We have those structural rigidities which lend us to a slightly higher risk of overheating more quickly than other economies. So I think to that extent, monetary, I'm not saying the answer lies in higher interest rates. It could be a combination of interest rates or macroprudential measures or some kind of risk weights being adjusted, just as it was adjusted for consumer loans in the right direction last year or the year before. Maybe the time has come to look at some of these risk weights in the other direction. We just need to become more flexible about these. So I think the overheating definitely is indeed happening, if not in terms of FII flows, in terms of the amount of subscription you are getting for IPOs. And these CAPE ratios, etc. And there is plenty of anecdotal evidence as well in terms of retail participation, etc., and so on. So policymakers obviously have to rely, as always, on a lot of their own judgment in coming to these conclusions. We can't always go by very well-defined quantitative metrics here.
No, absolutely. On the inflation, the pure sort of consumer price inflation side, what's your thinking? I mean, at one level, the point made by Dr. Michael Patra was completely valid, that you can't disinflate very quickly. There is obviously a growth sacrifice there. On the other hand, I think the point that I raised in my article as well is that, is it now for the RBI to lay down that disinflation path? Whether we like it or not, we do have an inflation targeting framework now.
As you laid out, what did you say about that? Is it RBI?
Is it for the RBI to lay down that disinflation path? My point was that we have an MPCV, and again, in the emergency period, we may have been justified in veering away from the letter of the inflation targeting framework. But as that emergency passes, we have to start restoring the credibility of it, or it will be like the FRBM framework.
No, I remember, now that you mention it. Yes, I remember reading it in your piece, and also I read the text of Mr. Patra's speech, which you had referred to also in your article. Look, I mean, whether they are making a mistake or not is something. So to be honest, we can also say we can't say with any amount of certainty. While there is a possibility that it could be a mistake, but obviously both of us would be able to figure out only after the fact. But I remember Dr. Subbarao talking about way back in 2010-13 period. his problem was not so much that he didn't tighten in time, which became evident in hindsight. But here he was going to every G20 meeting and them talking about continuous strains in the Eurozone, continuous strains in the US economy. If you remember, in 2011 or 12, the US did some Operation Twist and extended their QE program. So you go there, you attend the G20 meeting, and you hear all of them still talking only about growth risks rather than having to normalize. Then you also start to wonder, what if I end up making a mistake by normalizing too early? So I think to some extent it did influence his thinking. So similarly now, as even if they have, let's say, inclined to give signals to the Indian market about normalization sometime soon, suddenly they hear about this Evergrande thing happening. And then the possibility of spillover into other emerging markets, particularly in Asia, etc. Although in the India's case, one could actually argue that it might work out to be in India's favor. So rather than that being a dampener, it could be an additional stimulus in that sense. So I have a feeling, therefore, these considerations must be weighing on them. But I agree with you that once you have a framework, while I have written enough about the inflation targeting framework and its limitations, I'm not a votary of it. But if you have a framework, then you might as well sort of err on the side of caution in the market, interpreting that you have become relatively lax about it. That impression we should not build up. Then it would be probably more appropriate and consistent to even then formally sort of move into a different framework. But once you have it, if we take a very elastic definition of it, then the risk for an emerging economy is that it stretches credibility. And unfortunately, the reality is that financial markets do treat emerging economies and developed economies differently in this matter.